quite a full house. Very impressed. I'm not surprised, to be fair. So just to give you a little bit of background, exchange-traded products, ETFs. Quickly, how many of you have heard of them? Just raise your hand. Oh, this makes me so happy. And I'll tell you why, because I've been actually speaking to IFAs, and some of them are still learning about them. So it's very interesting to see consumers like yourselves actually listening, hearing about ETFs, and being interested in them. So we're going to talk about who ETF securities are, how exchange-traded products work, what they look like, what you should look at when it comes to commodities and foreign exchange, why they're important as a diversified portfolio. So, an introduction to ETF securities, what exchange-traded products look like, commodities, foreign exchange, and the benefits and risks of investing in ETPs, what they cost as well, why they're looked at by consumers like yourselves. So, ETF securities, we are an independent exchange-traded product provider. So we currently have $19.5 billion under management, most of that physically backed by actual assets. Our chairman listed the very first gold product in 2003 in conjunction with the World Gold Council in Australia. He then came out and did the same in 2006 in the UK and listed the gold product here. We have over 300 exchange-traded products listed on all major stock exchanges, and this ranges from gold all the way down to wheat, short and leveraged, and foreign exchange. Because we're independently owned, we can partner up with anybody. So we are not owned by any kind of a bank, so we can choose any bank, any counterparty that we seem suitable to be our counterparty. We have partners such as Bank of New York Mellon, HSBC, Shell, and the World Gold Council. So our offering, like I said earlier, we are mainly a commodities house. We also do currency and equities. When we talk about commodities, we're looking at agriculture, industrial metals, energy, livestock, precious metals. We do currencies, long and short, baskets, and our equity ETFs are thematic equities, so they're more specialized. They're not your standard everyday FTSE 100. So just something for you to think about. So what are exchange-traded products? Okay, there's two kinds of investments. You have an active and a passive. An active managed is you have a fund manager who looks to outperform an index. He's going out there and he's saying, I think that my expertise to understand companies is by far the best. And so therefore, I'm going to choose individual stocks and shares to put them into a fund and outperform something like the FTSE 100, right? You pay a premium for this. Do active managers always outperform? What do we think? Exactly. So if you think, I actually want to invest in the FTSE 100, I think that the FTSE 100 is going up, then I'm just going to get a passive fund. And that's where an ETF comes into play. Single unit, and the underlying constituents are all made up of the FTSE 100. It's as simple as that. Another one that's very good is the S&P 500. How many U.S. active fund managers do you think outperform the S&P 500 here in the UK? Not very many. That's correct. So why would you go and use an active fund manager? So you'd look at a passive fund. We talk about having diversification in portfolios, and this is why you would look at something like an exchange-traded product, a passive fund management. So what are the characteristics? Again, passive investment, it's just tracking an underlying. It's a cost-effective way of gaining exposure to a benchmark or an asset class, such as gold, silver, platinum, oil, wheat, anything like that. It tracks an underlying, so it's like a tracker fund. It's open-ended, so shares can be created as and when necessary to meet demand. They don't close. It's listed on exchange. You can go to your stockbroker and purchase them just like an equity, just like a share. And there's no stamp duty on them. Another bonus. So ETP is a classification. So we tend to say ETFs. A lot of people hear ETFs, so exchange-traded funds. ETPs is the actual umbrella term, exchange-traded products. And we're going to talk about the three differences. So an ETF, an ETC, an exchange-traded commodity, and an exchange-traded note. Okay? So what's an ETF? So ETFs are usually eligible for SIPs and ISAs. They are commonly structured as UCITS, and they are governed by the EC directive. What does this actually mean? Right, there are safeguards that include in an ETF. Again, like a fund, they have to have segregated assets, which means that you cannot invest into a single asset over 20%. It has to have diversification purposes. It is highly transparent. You know exactly what is sitting in your ETF all the time, every day. You go onto the website, you can see exactly what sits in that underlying. If there's rebalancing, you'll see it. So, a lot of active fund managers will post their 10 top holdings. With an ETF, you'll see everything. That's where the increased transparency comes. And you have robust risk management, so it's held separately outside of the ETF provider. There's a counterparty there that holds it in a custody outside, so that if the product provider were to go under, your money's being held separately in a segregated account. So you don't worry about that. And it's collateralized, which means that there's up to 110% collateralized if it is a synthetic product, and we'll talk about that a little bit more. Exchange-traded commodities and currencies, right? So again, this is slightly different in ETC. Whilst it is not structured as a UCITS, because you're looking at a single asset, it is eligible for a UCITS. So a lot of active fund managers will probably use something like an ETC to give exposure to gold or silver or anything like that. They are usually eligible for SIPs and ISAs unless you can redeem the product. So if you can actually redeem for the gold to come out, then you cannot invest it into your ISA, okay? And it gives exposure to a single commodity such as energy. So if you're looking at the price of oil, if you're looking at agriculture or industrial metals, then you have access to go and purchase that single asset class. Okay? Exchange traded notes, slightly different. So they track an underlying benchmark, but they're issued by a bank. Okay? So there's no assets held, and they are not collateralized. So you are actually taking on counterparty risk of that bank. So if that bank were to go under, your structured note would actually also go under. So it's similar to an unsecured listed bond. And they operate differently from ETFs and ETCs, and they're not UCITS compliant. Exchange traded notes, there's not very many of them. There's fewer of them, but you tend to see more ETFs and ETCs. So what's the structure of an exchange-traded product? We talked earlier, I said physical replication and synthetic replication. Physical replication, you purchase your ETP, your ETC, or your ETF, and you actually hold all the physical underlyings. For example, active fund manager, FTSE 100, goes out and buys all of the 101 constituents that sit in the FTSE 100, wrap it up into an ETF, and then you've got exposure to that. And it's physically replicated, so they actually hold all of those constituents. Synthetic replication means that you have a swap agreement with a bank. So basically, the exchange-traded product provider goes to a bank and says, I'm interested in purchasing the exposure to wheat, the futures price of wheat. So they come into an agreement. The bank will say, we're going to charge you X amount to have that exposure, and we will then give you the exposure as and when your product is being sold. Okay? So it's a synthetic replication. It is not actually physical. That's where the counterparty comes in, and that's where the collateralization comes in. So what the exchange-traded product provider does in this case, in order to ensure and safeguard the synthetic replicated product, goes out and says, we're going to then purchase gilts and bonds and put them in a separate account and make sure that if anything were to happen with that counterparty, we've actually got it all collateralized so that we can pay the individuals back. Okay? So that's the difference between a physical and synthetic. You sometimes will also get a sampling physical. For example, if you want to invest into the MSCI emerging markets, there's lots of underlying constituents. You can't go out and purchase them all. So what you would do is you would go out and purchase, you would still do an ETF, but you would do sampling replication. So you'd get all the largest constituents in there and put them into your ETF. Okay, if it were to be done physically. Sometimes it's actually more cost effective to use a synthetic replication because it's not as expensive. You have to remember there's rebalancing and all of these things that have to take place. So for example, synthetic, because it's only a swap agreement with a counterparty and they're giving you that performance, you could actually say it's going to be more cost effective for us to do it synthetically versus physically if you've got so many underlying constituents. Okay? So those are two structures. So commodities and asset class. Why is it important to think about commodities? It's an interesting one because commodities, until probably the last 10 years, weren't really looked at unless you did it over the counter. And it was very difficult for consumers like yourself to get access to commodities. Now, with exchange-traded products, commodities are actually very accessible, very easily accessible as well, because you can purchase them with your stockbroker and so on. And we consume commodities on a daily basis. You can see here, we eat, we use the oil, money, everything, wheat. So, urbanization is a key factor. If you look here at 1991 in Dubai and Shanghai, right? What do you think it looks like in 2005? Right? And obviously, populations are growing. The need for industrial metals is very high. You can see what China's doing, where they're going, and so commodities are constantly in demand. So why wouldn't you have them as part of a portfolio? It's key to think like that, really, as a diversifier. So rationale for investing in commodities. So again, like I said, diversification benefits. It gives your portfolio a full exposure. You don't just want equities and bonds, you're also looking for commodities. What we tend to see is that commodities are used as a risk against inflation. And they have a positive relationship, like I said, positive relationship with inflation. And it benefits of economic growth in emerging markets. So you just saw the picture between Shanghai and China and where they're looking like today and can you just imagine in another 10 years' time? Populations are growing, people are consuming more meats, more wheat, and so therefore commodities are a very important part of everybody's life, really. You can see here the diversification properties of commodities, how it's positively correlated, the difference between the Barclays Global Bond and the MSCI World. Commodities versus inflation. An interesting comment I'm going to read. So, take the example of the Ontario's Teachers' Pension Plan, which manages a portfolio of over 110 billion Canadian dollars, has 5% allocation to commodities. And I quote, "We invest in commodities such as energy and agriculture products as a hedge against the cost of paying inflation-protected pensions. In the short term, commodity prices reflect supply and demand imbalances in global markets as well as short-term changes in inflation. Over the long term, commodity prices reflect inflation expectations." So you can see here that this pension fund actually looks at that for these reasons. So the rising wealth is likely to drive structural increase in commodity demand. You can see here. So it's very interesting. So you see where China is versus the US, Australia, higher GDP per capita. China, Malaysia, Egypt, India, these places are all rising. So what's going to happen? It's going to literally just, the drive, the capacity for commodities is really just going to go on. It's going to drive the price of commodities up. Whilst they are seen as slightly more volatile, still something that should be part of a diversified portfolio. This is one of my favorite slides, and I'll tell you why this is one of my favorite slides. 10 years. No single asset class stays on top, year on, year out. Real estate 2004 comes down, then it comes all the way down in 2007. So it comes back up in 2008, 2009, in 2012. You know, and it's done interestingly. Again, commodities up 2005, 2007, somewhere in the middle, then down, and then back up right here. It's all about diversification. It's about ensuring that your portfolio is fully diversified. Because equities are going down, commodities might be coming down. Equities are going up, commodities might be coming down, and vice versa. In making sure that your portfolio is hedged against any risk is the key here. So foreign exchange. Why do we think about foreign exchange? Interestingly enough, I was listening to CNBC last night, and we see that the dollar's actually coming down. Sorry, the dollar's going up. GBP is coming down due to the Scottish voting. So you might have equities currently in USD, which will be positively affected. But vice versa, if the dollar was coming down and GBP was going up and you have USD exposure, then you have a risk there to foreign exchange rates. This is why we look at portfolio diversification with a foreign exchange. It is the largest traded asset class, most liquid in the market. In 2014, there was a study done where it was $4 trillion daily traded in foreign exchange. Something to bear in mind. And it has a low correlation with traditional asset classes. Again, very similar to commodities. It's all about diversification, and it's seen as an alternative asset class. So, as I was saying earlier, you potentially have USD products in your portfolio. So you have this open invitation to the fluctuations of currencies. So buying a foreign retirement home, owning shares in a US-listed company, and commodities that are listed in US. This is why you would look at foreign exchange. And absolutely, you can go out and purchase your dollars and hold them, but how much easier would it be if it's sitting in your portfolio and you're actually diversifying it there? You can see that currency fluctuations can both positively and negatively affect the returns of an underlying investment. And here, you can see if you would have been invested in US equities and you're a GBP-based investor, how much you would actually lose when the fluctuations with the foreign exchange happens. So you can access currencies through various currency ETPs, single currencies, so GBP versus USD, GBP versus yen. You can do currency baskets, and you can actually purchase currency hedged ETPs. For example, you can buy a gold product that's already hedged with the currency in GBP. Gold tends to be priced in dollars, but you can actually purchase the product in sterling. Just something for you to be aware of. So exchange-traded products is building blocks of multi-asset portfolios. We tend to talk about how you can actually build a portfolio with all sorts of exchange-traded products to keep the overall cost of your portfolio down. In this example, we've got 50% equities, which tends to be the norm, 35% fixed income, 10% commodities, and 5% currencies. Exchange-traded products give you access to any asset class, any underlying, and you can see here the examples of the ETP constituents. You can have access to the FTSE 100, S&P, giving you your US exposure, the DAX, your emerging markets exposure, and your gold mining. This is just an example of how you can build a portfolio and keeping the cost relatively low. Your average exchange-traded product, if it's something as simple and plain vanilla as a FTSE 100, can cost you 0.09% per annum, versus an actively managed fund that could cost you anywhere between 0.75 and up to 1% per annum. You then have fixed income, again, US Treasuries, global corporate bonds, EU government bonds. Various providers out there provide this access to these kinds of products. Again, commodities, you can have all commodities. If you're looking for a full exposure to every single commodity, just not a single commodity, you can look at a basket of all commodities, which literally has a breakdown of everything in there. Precious metals, industrial metals, agriculture, energy, and so forth. Or you can have a particular exposure, such as crude or physical gold, and then you've got your currency to actually hedge yourself against that fluctuation in the currency and the foreign exchange. So you can actually use exchange-traded products to build an entire portfolio, keeping the overall cost of your portfolio down versus paying high fees with not much return at the end. So what are benefits and risks of investing in ETPs? Right. So, as we said, they are very simple. They are listed and traded in the same way as shares through the brokers and platforms. You know exactly what you're purchasing, 100% transparent, they're accessible, and they can be bought and sold whenever the exchange is open. You know exactly what the price of these products are. It gives you full diversification, so you can actually access any asset class and alternative asset classes. They're cost effective, again, very low cost, such as the FTSE 100 example. They're transparent and they are flexible so that you can achieve anything that you're actually looking to achieve when it comes to your exchange traded product in your portfolio. Risks, like any product, market risk. The FTSE goes up, FTSE goes down, you've got market risk. Tracking difference. This is really important. Tracking difference is quite important when it comes to an exchange traded product. Reason being is, if you are looking to track exactly the FTSE 100, your product should literally be exactly that same price minus the fees. So, for example, FTSE 100, you're tracking the FTSE 100, the product should be the same as your FTSE 100 index minus 0.09%. That should be the value of your product. So it's very important to make sure that you're looking at tracking difference when you're looking at your structure. Tax, we always say please make sure that you get independent tax advice on them. Cost, effective, and sometimes you incur two types of costs. Like a share has bid and offer spreads. We'll talk about that a little bit more. And currencies. Some exchange traded products will be denominated in USD, some will be in GBP, some will be in Euro. Just make sure that you're aware which product you're purchasing and how it works, and the currency against it. So costs. Total cost of ownership. So this is a very important factor because we're looking at the total expense ratio, so that's any rebalancing costs and any swap spreads. So rebalancing, again, if the FTSE 100 changes a few companies underneath, then we're going to have to charge a rebalancing cost to do that as well. Okay? If you have a swap fee, it's on top of whatever the management fee is. So it should always be very clear and transparent. And all these brochures will say, this is what the fee is, this is what the swap fee, because it's a synthetic product. Then you have your external costs, like I said earlier, bid-ask spreads, your brokerage fee, whatever your platform is going to provide you, your stockbroker, and the tax. And that's your total cost of ownership. So whilst the initial total expense ratio will be relatively low, you just need to make sure that you factor in all the other bits and pieces. So beyond TER, this is a really important one because in this example, you'll see that you've got two exchange-traded products. One is 25 basis points and one is 40 at the onset. So you'd always say, oh, actually, I'm going to go for the 25 basis point one, 0.25%, by the way, to be exact, versus 0.40%. Then you have rebalancing costs. Like I said earlier, FTSE 100, you're going to rebalance it if a few companies come out and new ones come in. ETP1 is going to charge 0.15%, whereas ETP2 will only charge 0.05%. So already there, you've got a difference. Then you've got securities lending. So sometimes physically backed exchange-traded products will lend out some of the physical underlyings to gain higher exposure and to gain more money on them. And that will also be, so there's a negative there. Then you have bid-ask spreads, so 10 basis point, 0.10 and 0.06. So that's what it's going to cost you. So you see the total cost at the end is actually 45 for ETP1 and 36 for ETP2. So whilst ETP1 looks cheaper by 15 basis points, all the cost of ownership actually becomes 9 basis points more expensive. Something to look at and bear in mind. So the conclusion, ETPs are designed to replicate the return of an underlying benchmark or asset. They're easy, they're accessible, traded on the exchange, you know exactly what you're purchasing. You can choose between physical and swap. Make sure that if you are looking at a swap-based product, you understand exactly what the collateral is. Like I said, one of the key things with exchange-traded products, and this is why so many retail investors like them, is because they have to be fully transparent. You have to know exactly what sits there, who the counterparty is, what the collateral looks like. The providers have to put that information out to you. And that is the key. Commodities and currencies being potential diversifications. Again, you would look at a portfolio and you probably think about anywhere between 2 and 5%. You're just hedging your risks against any kind of inflation, any downside in equities. That's why we look at commodities in foreign exchange. And due diligence. You must understand what you are purchasing. It is the key. And it is our job as product providers to ensure that we are giving you everything that you need to be able to make the right decision on your products.